morning, everyone. I think that's most people kind of ticking through the waiting room. So welcome to our summary of the SORP and charity size threshold consultations. I'm Cara Turtington and I'm the head of the charities team at Saffery. And I'm joined today by Helen Wilkie, another of our specialist audit partners, who is going to take you through some of the trickier bits of the consultations that are going live. And I think Helen's going to share the slides. So today we've got 45 minutes or so together to pick out some of the highlights of these consultations and to get your opinions on the questions that are being asked. We're going to run through what the consultations are trying to do and how we and you might respond. We're going to pick out a few of the key issues and then answer any questions you might have in the time we have left. And yes, I'm afraid this is an interactive session, and so hopefully you've all had your coffee this morning. Throughout the session, we're going to be launching polls that you can answer by clicking on the relevant answers. They're kind of multiple choice, and also some Slido polls. I'm aware that most of you are familiar with these, but just for anybody who hasn't done this before, if you've got your phone handy during the session, on some of the slides a QR code will appear, and that will be accompanied by a question. If you click on the QR code through your phone, the code will take you to a site where you can enter your thoughts as a word or a phrase. And this should then magically generate a word cloud for us all to see on the screen, and we'll talk about the themes that are coming through. If you do have any other thoughts during the session, or indeed questions that you want us to answer, then please drop them in the Q&A box, which you'll find at the bottom of the screen, and we'll try and get through as many as possible by the end of the session. If we don't get to your question, you can, of course, email your normal Saffery contact, and they will pick that up after this webinar today. So just to start with some housekeeping, this webinar is being recorded. The recording will be available on our website and will be kept for up to a year. No attendees can be seen or heard. The chat function is disabled and we will keep all questions anonymous. You'll receive an email with a link to the recording as a follow-up once we've completed the session. So, with little more to do, we will get into the detail. And we start with the thought that consultations are like buses. We don't get one for ages, and then several come along at once. There are two particularly relevant consultations for charity finance professionals at the moment. At the end of March, the consultation on the new SORP was launched, and then shortly afterwards, the Department of Culture, Media and Sport launched its consultation on financial thresholds in charity law. They are both relatively lengthy documents and are specific questions of the respondents to try and gather data from the charity sector that will inform either action by government or the publication of the final materials. Most of the major sector bodies will be responding. We as Safferys will be submitting a response to each as a firm. Within our response, we will try and capture any themes or points that are raised here today. But if you feel strongly about any particular point, we encourage you to submit your own response. It's relatively simple to do online. We can send you the links to that. And it's worth saying there is no obligation to answer every single question. Responses from charities are strongly encouraged and sometimes given a little bit of extra weight. As I mentioned, there are specific questions within the SORP consultation, but also opportunities to raise wider comments. To understand the requirements of the consultation, though, it's probably helpful just to refresh on the background. The Financial Reporting Council committed to reviewing and refreshing FRS 102 periodically, and the next significant refresh comes into effect for accounting periods ending on or after the 1st of January 2026. The revisions to FRS 102 have been confirmed, and it's therefore essential that all entities that report under FRS 102 comply with the revised standard from this date. The major changes will align some elements of reporting more closely with international financial reporting standards. All SORPs, including the charity SORP, are therefore being updated. Of course, as well as changing what is required by the accounting standards, it has been a good opportunity for the SORP making bodies to reflect on the current additional information that the SORP requires and update it as appropriate. That does mean, therefore, that there are some specific limitations to the consultation. You might not like some of the proposed changes, but if they are mandated by FRS 102, we cannot change them, and this consultation cannot bring about that result. What we can do is make sure that there is appropriate guidance around how these rules can be applied in the charity sector. So on the next slide, you can see the timetable for the SORP making process. We are currently in the middle of the bottom line, and you will see that in order to publish in October for a 1st of January 26 implementation date, things need to be moving fairly quickly. If some of the points that Helen raises today are of concern to you, there are definitely steps you can be taking now to prepare. And with that, I will hand over to Helen.
Thanks, Cara. So, as Cara has explained, the SORP provides guidance for charities on how to apply FRS 102, and it cannot be inconsistent with FRS 102. And so where FRS 102 is changing, those changes have to be reflected in SORP. As many of you are probably aware, 2 key changes came out of the periodic review of FRS 102, which will come into effect 4 years commencing on or after 1 Jan 26. And they are changes to income recognition for exchange transactions, which is what we're going to start with here, and accounting for operating leases, which we'll come on to in a moment. So on income, the exposure draft has been updated to maintain consistency with FRS 102, and it provides additional guidance in some areas. Notably, it has been restructured into 2 parts for income from exchange transactions and income from non-exchange transactions. So exchange transactions, Del Boy on the slide, these are income received by the charity for goods or services supplied under contract with third parties. And these are the ones that are going to potentially be affected by the changes to FRS 102. So these will be the ones where you have to recognise income in line with performance obligations using the 5-step model that is set out in revised FRS 102. And the SORP provides some quite lengthy guidance on this, running to about 12 pages. Non-exchange transactions, the sort of money for nothing, donations, legacies, these are not going to be subject to the 5-step income recognition model. And so the good news is there'll be minimal change in this area. And so for many charities, actually these changes are unlikely to have a significant impact. Because the SORP cannot be inconsistent with FRS 102, there is a limit, as Cara said, to how far the SORP committee can go with making any changes to the drafting. But what they can consider are suggestions to make it more user-friendly. And one question they have asked, which we would appreciate your input on, is, do you think the guidance on exchange and non-exchange transactions should be set out in separate modules of the SORP rather than separate sections of the same module? And hopefully you've seen the poll pop up on your screen, which you can click into and answer now. Very interesting. Thank you, everybody. So what we can see is that 72% of you think that having separate modules would indeed be helpful rather than having one Mahusive module that covers the lot. We also think it would be helpful just on the drafting. We'd like your input, and this time we're giving you a free-form question answer. What could the SORP committee do to help you to better navigate the accounting and disclosure requirements for income? So as Cara says, this is about how do you apply it in practice? What could the SORP committee do to make your life that bit easier? And so hopefully you can all see these responses live with the answers feeding in on your phones. Providing examples seems to be the overriding theme coming through. Thank you very much, ML, for sharing that. And Cara and I have been talking to lots of clients about this and indeed helping other people feed into their consultations from some of the sector bodies. And this is very much consistent with what we are hearing elsewhere. Example disclosures, example accounts, checklists. And good to see training in there. We'll come back to that later. So if I move us on, and of course, if you want to keep chipping in, you can keep doing that. Looking at leases. So the current FRS 102, as you may be aware, allows charities to account for operating leases as an expense. And that's all quite straightforward, and we're all very grateful for it. The new FRS 102 will require charities to account for most operating leases on the balance sheet. So as a result of this, a lot of charities that lease assets will see an increase in assets and liabilities on the balance sheet. There are certain exemptions for lower value items, for assets used under license, for peppercorn rents, but a lot of leases, particularly those for land and buildings, will be caught by this. So a lot of leases, particularly those for land and buildings, will be caught by this. And so charities will need to bring the assets and liabilities onto the balance sheet for years commencing on or after 1/2026. And there's quite a lot for charities to work through where they're impacted by this. We don't have time to go through all of that today, but what we wanted to flag is two areas that have already been identified as potential challenges. One is the requirement to discount future lease payments to present value. So when bringing lease liabilities onto the balance sheet, charities will need to take into account the time value of money on the lease liability, discounting future lease payments to present value. Accounting for lease arrangements where the payments are below market rate could also impact certain charities. So some charities will be getting rent that is cheaper than a commercial counterpart, and they will need to think if there is a gifting kind element where that is the case, that they need to reflect in their accounting. If they are giving leases at below market rate as a lessor, they'll also need to be thinking about whether there's a social investment element to that they have to account for. And helpfully, the SORP does have examples you can refer to help you get your head around this. And the SORP making body acknowledges it will be a challenging area for charities to understand and make the necessary changes. And so again, FRS 102 is what it is, and there are limits to what we can do to influence the drafting. But where we can feedback and feed in is on the guidance that the SORP sets out and how digestible it is and how useful it is to you as users. And so if we move on to the next slide, we'd like to invite you to input again into a poll, asking you whether the leasing module explains the requirements in a clear and understandable way. And if you can please select all options that apply, that would be really helpful. So hopefully you can now all see the answers on the screen. 38% of you, this is what stands out to me, have no opinion. And I have to wonder whether that's because you haven't yet had chance to fully digest the 26 pages of this thrilling module. 27% of you have said actually it is quite clear, so that's good news that for some of you it is working. Others of you have said actually you do have questions in some areas, and in fact it's interesting seeing that there's a spread of kind of questions across all of the different areas that we've highlighted there, suggesting that there will be a benefit for many of you in having some additional guidance and perhaps potentially some training in the requirements on leases and the disclosures, and indeed how to apply them. And so moving on, and hopefully our helper will do this. Lovely. We wanted to give you a bit of a free-form opportunity to input into what could the SORP committee do to help you better navigate the accounting and disclosure requirements relating to leases. So particularly for those of you that answered no to some of those questions, now is your chance to tell us what you would find helpful. So I think, again, we're seeing some overriding themes coming through with examples, that word in green at the centre of the screen, standing out clear, training and examples, complex examples there for one. But I think this worked examples of showing what you'd actually do in practice is what we're seeing that you would like, and certainly what we're hearing from other people. And so if we move beyond leases, a really significant structural change, I suppose, to the SORP is the tiered reporting requirements. So it's quite a big change from where we are currently, where we're used to 2 tiers of reporting for the annual report. So the annual report in the SORP currently sets out requirements between those that apply to all charities and the additional requirements applicable to larger charities, being those with income of more than 500,000. And those writing the SORP were tasked with thinking small first, and the challenge of working out what is proportionate disclosure for smaller charities. And their proposal, the suggestion they've come up with, is that we move to 3 tiers of reporting. Tier 1 charities will be income up to 500,000. The second tier they've proposed is those with between income of 500,000 and 15 million. And tier 3, your venti Starbucks cup, is those with income of 15 million plus. And the impact of falling into these different tiers, it will differentiate between the disclosure requirements that are required of different sizes of charity. So that will impact what you report in your annual report. Largest charities will be required to say more in some areas, such as sustainability, than those in tiers 1 and 2, who can still provide those disclosures if they want to, but they won't be required to in the same way. There will also be a cash flow statement exemption available to tier 1 and 2 charities, which some of them may well appreciate. One of the areas of debate relates to the new and enhanced disclosure requirements in relation to reporting on a charity's impact. And so on the next slide, we've provided a bit more information about this. So under the revised SORP, charities in all tiers will be required to explain how their work has benefited society as a whole. And the new SORP also includes some prompt questions. These prompt questions, we've put examples on the screen. You will see that these questions are musts. So they're not nice, helpful suggestions of things you might like to include. They are things that you will now be required to include. So the smallest charities, as you can see here, will need to say in what way has the charity's work made a difference to the circumstances of beneficiaries, and has it provided any wider benefits to society as a whole. Tiers 2 and 3 will need to do that, but they will also need to provide answers to the more detailed questions that are set out on the right-hand side of the slide, looking at significant activities and the differences the charity seeks to make, and also looking at criteria or measures, so non-financial KPIs often, that are used to assess success in the reporting period. And from the discussions we've had with charities, some charities have said, look, this really won't make a difference to us. We're already doing all of this. We're already reporting on all of these areas. And so this just chimes with what we're already doing. And others, particularly some of our sort of grant-making charity clients, have said, look, this will really be far more challenging for us. And so what we'd appreciate your input into on the next slide is what would help you to apply the revised requirements on impact reporting. We appreciate there are many different sizes of charity. It's a very wide, diverse sector, and therefore the impact of these requirements will be different for different charities. So what would help you? And again, we've got that word examples coming through. So I can see in there, we've got checklists for each tier. Certainly we've had other people sort of say that might be helpful, and I can see the benefits of that. There's been a lot of debate on the benefit of examples, with some people fearing that if they put an example out there, every charity will copy paste it into their annual report. But certainly it might help to give a flavour of the sorts of things different types of charities might want to be thinking about. Fantastic. Thank you so much, everybody. And so moving on, we're now going to talk about managing transition. And Cara, I'm going to hand over to Cara to pick up on this bit.
Thank you, Helen. Yes, it is interesting. And examples, I think if you do feel really strongly around things like example accounts, this is where making a representation is really helpful, because there are definitely mixed feelings around whether to issue things like template accounts. And the more that the sort making body can hear from charities, the better. But we're going to talk a little bit about transition, because when it comes to transition, things aren't straightforward. And if what Helen has been talking about impacts you, then you need to think about your implementation strategy. To keep things as complicated as possible, if the leasing changes impact you, then those changes are brought in without restating your comparatives, with any adjustment to your balance sheet in the first period of accounts. So that would be December 26, March 27 or thereafter. That impacts your reserves brought forward. And you will kind of produce a transition note. Just by those of us who are old enough to remember the last time we did this, you show that in a separate one-off note to the accounts. However, if the income recognition changes impact either the charity or its subsidiary, of course, we've been thinking very much about the SORP today, and the fact that non-exchange income is not heavily impacted by the recognition changes. But of course, if you do have a trading subsidiary, it is likely that all of its income will come from exchange transactions. So you need to think about this for both entities. And then you can restate the comparatives on income, but not on leases, which is where the impact is difficult to quantify and something to be thinking about sooner rather than later. In particular, you need to think about your impact on reserves and any impact that might have on other reporting that you're involved in, particularly on things like bank covenants, so you can start those conversations early. We have the opportunity to ask the sort making body for any additional support we think would be helpful, such as examples and fact sheets. And in fact, we are planning, and hopefully this will be a relief to you, to provide more support on this throughout the next 12-month period. We can do this via written guidance, via webinars like we're doing today, via in-person training. We can provide a long session that tries to cover all of the changes in the SORP, because Helen has picked out 3 specific things today, but there are a lot more nuances to consider. We could do more bite-sized chunks, more half-an-hour updates that you can replay at a time to suit you. So our next question is what you would find most helpful in the next 6 to 12 months to help you plan for year 1 implementation. Then we can both ask the sort making body for what we would like them to produce as guidance, but also so that we can tailor our training program over the next 6 to 12 months to your needs. Great. So yes, so training sessions with auditors. I don't know why auditors are so popular sometimes, Helen. This is making us feel good. We go to conferences and people always ask to speak to the VAT specialist. So this is our year. Everybody's going to love us, which I think is great. But yes, webinars also coming through as popular, which is good. So we'll definitely make sure that we're providing short, sharp responses. And following the completion, when we circulate the recording of this today, hopefully there will also be a chance for you to make any further comments, make any further suggestions, time of day that works best for you. So we're happy to tailor our approach to where you are. That's really helpful, thank you. So that was our kind of first half of this webinar has just covered the SORP. And so now we're going to have a quick look at this other consultation that is live. And I think for me, this is quite interesting because there are numerous thresholds in charity law that impact accounting and reporting, as well as registration with the Commission. And also things like fundraising regulations, which often aren't thought about in the same phrase as accounts. If we can just bip onto the next slide, please, Mary-Louise. In response to feedback from many parts of the charity sector, the Department of Culture, Media and Sport is now consulting on whether the thresholds that exist within charity law should be raised in line with inflation, and whether there is a suitable time frame for a regular refresh, as I think we would all agree that keeping things simple and not changing these thresholds every year is important. Within terms of how often these should be refreshed, the suggestion is potentially every 10 years, with the opportunity to look at that in a period where things are changing. But I think, yes, continuing to look at these, because when you look at where the thresholds have moved from and to, a lot of things have changed. The key thresholds that are relevant to accounts are to raise the registration and independent examination threshold from £25,000 to £40,000, to raise the level at which unincorporated charities can prepare receipts and payments accounts to £400,000. It's currently at £250,000. And to raise the audit threshold to 1.5 million income from its current 1 million income. As I said, there are about 20 questions in the consultation. A lot of them kind of flesh out some of these examples. But I think those are the three key ones around registration and being below independent examination, around receipts and payments accounts, and around the audit thresholds. Within the consultation, the Commission cites reasons for not increasing the thresholds, such as loss of helpful data and the need for scrutiny of all charities. However, at the same time, it might be thought that the charities that are now being caught by some of the more onerous reporting are not those that were originally envisaged to. And those smaller charities are needing to spend more on compliance than perhaps the original writers of the charities legislation thought they would need to. So keeping things static is certainly pulling more and more people into compliance. It's worth saying at this point that this is only relevant to charities in England and Wales. Changes to the regulations in Scotland have already been agreed, so that the audit threshold in Scotland will move from £500,000 to £1 million income, which means shortly, for the first time in a very long time, the thresholds for audit will be aligned. But of course, if the consultation from the DCMS goes forward, it is not clear for how long that will be relevant, because it could be that the Scottish audit threshold will again be lower than that for charities in England and Wales. Just to think about two trains going on different tracks, I'm talking about £400,000 here. Of course, you might be thinking Helen talked only 10 minutes or so ago about Tier 1 charities being those with income of less than £500,000, rather than smaller charities being those with an income of less than £400,000. It's absolutely true that that is where these are two consultations running at almost the same time, suggesting different reporting levels. And so our next question to you is whether you would appreciate consistency within these reporting thresholds, and we would appreciate your thoughts on this. So we're going to ask the question of size thresholds. Do you think, or would you appreciate consistency between the thresholds set out in the SORP and those set out in other charity legislation? Well, I think that's a resounding yes, Helen. 100% of people think that this would be sensible. And I have to say, if I'm giving the opinion of the presenter and not of the firm, I wholly agree. The complications that could exist for a small charity of maybe 2 million income that is registered in both England and Wales and Scotland, if all of these proposals go ahead, is immense, because you'll be asked to constantly review which set of rules you're reporting under. And so I think we will, whilst it is not an explicit question within the consultation, as I said, there are these kind of white box spaces, and we will be representing your views on that. And then our final question is just to consider whether you agree with the increase in the audit threshold. So thinking about where we are at the moment, do you think it should stay at 1 million, be somewhere between 1 million and 1.5 million, be increased to 1.5 million, or be raised higher than 1.5 million? I think we've said if you have specific thoughts on either answer B or answer D, you can pop further comments in the Q&A that we will pick up. But yes, there is quite a lot of anecdotal evidence that smaller charities are finding it harder to find auditors, and that the cost of audit obviously isn't getting any cheaper. And I'm not just saying that as an auditor. And so it would be really useful to know how you feel about this increase in the threshold. So yeah, so that is a fairly interesting, so nearly half of our respondents there agree with the increase to 1.5 million. That's the one that tracks inflation, and so is following the logic of a kind of an inflationary increase. But it is interesting that 21% of people feels that it should stay where it is at the moment, whereas 24% of people feels that it should go up further. So that's a much more varied bunch, but I think this is good information to have, and certainly something that we will build into our response to the consultation. So that ends our canter through some of the key points that we are building into our feedback for the consultations. And I'd like to start by thank you for your participation and for giving us this additional food for thought. We do have time for some questions, and looking at the Q&A, I can see a couple in there already. Obviously, as we said, we will be picking up some of the details, but I think the first one that I can see, Helen, which I will pass over to you because you've talked so beautifully about leases, is whether you could just give a minute around the difference for a lessor and a lessee in terms of who is affected by these leasing changes.
Thanks, Cara. So I think, so as we said earlier, it's about bringing operating leases onto the balance sheet. So as lessee, if you are renting a land and building for £50,000 a year for 4 years, at the moment you'd be expensing it at £50,000 a year. But looking ahead, you could be recognising a £200,000 asset and a £200,000 lease liability, adjusted in both cases, thinking about depreciation and discounting to net present value. Obviously, many leases run far beyond 4 years, so that's where the complexity will come in for many people. In terms,
yeah,
go on, carry on.
No, you go.
I think so. In terms of lessors, though, renting out those leases, I'm just trying to think in practice how that will actually impact them.
So it doesn't. I think that is the thing. So if you own the building and you are renting it out, you don't bring the asset of future rental income. So there is an inconsistency there. So as a lessor, that this doesn't really impact you in terms of your own financial statements. I think the thing that does impact you potentially is that your tenants may be coming to you for more information. And that will be hugely relevant if you let out a building as a charity hub. Maybe you're not charging absolute open market value. So whilst it will be useful potentially to understand the impact on your tenants and the questions might be answering, they might be asking you, there's nothing to put in your accounts and no changes to the way you account for lease income.
And I think that's particularly the case for all of those ones that are at a sort of standard market value. So one of the questions in the chat is, does it affect those who are kind of renting things out at market value? And I think the changes there, as we've just sort of said, are much more limited. It's from a lessor perspective, it's going to be to think about where you're letting things at below market value. If you're a charity doing that, are you doing that to further your charitable purposes because you are renting out, as Cara said, to those charity hub tenants and giving them a lower rent as part of your way of effectively giving them a grant to support their activities? And that's where you might find there is complexity and impact on your accounts.
There's been a couple of questions around whether there is fully updated guidance, the blue book or equivalent. I think what I would say there is, because this is still a draft, a lot of those publications that follow afterwards, full checklists, full guidance notes for specific subsectors such as independent schools, won't be published until this is finished. Whilst when you look at the questions in the consultation, some of them seem like almost wanting, how would I put this? Yeah, wanting affirmation that we're taking the right steps rather than looking for real change. I don't think until we actually get this signed off by the FRC in the autumn, those additional pieces of guidance won't go into publication. So I would expect them to be produced around the end of the year. Would you say, Helen?
I would say at the earliest. I think we'll start seeing potentially some checklists coming out. I know one of the things people have been asking about is, could they have a sort of a red pen markup showing old SORP and new SORP? The feedback has very much been, we've essentially redrafted this, so it would be so messy as to be completely unusable. But what we may start seeing is some checklists coming through. And then last time round, it's for the sort of SORP committee and others to decide if it's helpful. There were some example accounts produced, but they obviously take a lot longer to work through than a checklist, because people have to decide, if it's an arts charity, what do we realistically think people would say, versus if it's a large endowed grant making charity. So last time they did try and produce some industry specific things, but there's a lot more thought goes into that. And therefore, I think if we got those by Christmas, we'd be feeling very lucky indeed.
I think I can see from the questions in general, there are going to be a lot of very specific questions on leases. There are things that we will need to build into that. I think in terms of getting into the detail of things like VAT on partial exemption or capital goods schemes repayments, we don't have time to cover every scenario today, but these are all the questions that you absolutely should be asking. What I would recommend at this point, and the best steps you can be taking right now as you're going through your March 25 audit or signing off your December 24 audit, is to start by making a list. Make a list of all those leases that you have. These might be the smallest ones, such as your photocopier, but particularly if you've got anything around land and buildings, anything relating to larger items, those things that just happen. So if you can create that Bible of the lease you have, its expiration date, what you're getting in return for that, then you can sit down with your regular Saffery contact, with your auditor from elsewhere, and run through that list to say, this is what we think we have. Where do we take it next? And then when the further training comes out, and will be, for those of you that really want to get into the detail of numbers, we will definitely run a session where we get out a spreadsheet and crunch those numbers with you, that you can walk through. If you've already got your Bible of leases, you can be thinking about your example whilst Helen and I sit there with a model lease that's exactly £1,000 for exactly 3 years, because that's where we'll start, but you'll have that. We will run that as a separate session, because I'm aware that there are some trustees here today that will not want to crunch those numbers. They'll only want to be confident in the end result.
And if I just pick up on a specific question in the chat, because it's got my name attached to it, it says, Helen mentioned a 26-page document. Where can we find it? So the good news is that you can readily find it on the web, because it's the lease module that's within the exposure draft of the SORP. The bad news is that is a single module. The full exposure draft of the new SORP runs to more than 300 pages. So if you want to just look at that lease module, you'll find it very readily. If you type in exposure draft SORP 26 into Google, I think you'll find a link pops up almost immediately. There is a separate module on leases, and so you can go through that. You can dive into the detail of the examples they provide. But word of warning, it is not a checklist. It has not been written by auditors, so you will possibly need to get out your highlighter in order to digest it.
Yes, and I think that certainly talking to fellow professionals in other auditing firms and other people we deal with, I think this is where things are becoming more complicated. Over 300 pages of SORP, and actually more and more of the SORP now just says this is the rules, refer back to FRS 102. The SORP is not a one-stop shop, so you do end up sitting there with two very chunky documents, trying to work out if you've got guidance in one place or in another, and how you tie the two together. So yes, I think things that can distill specific chapters down so you can look just in one place is helpful.
I'm just looking through the questions. I think, given we don't have sort of scope today to do a full training session on leases, that possibly wraps things up.
Well, I was going to say the only other, I guess, top tips. We mentioned top tips for preparing for leases. I guess the other thing is to do a similar exercise on income. Rather than just saying it's fine, most of my income comes from donations. There will be charities on this call that say, no, I only get investment income and donations. And I think they can leave this feeling happy and confident. Whereas if you have annual membership fees, if you are selling entrances, if you are doing anything that covers a period of time in terms of transacting with members, selling things, entrances, longer term contracts, and that's obviously that could be 6 months rather than 3 years within your trading subsidiary. Anything that is not a one-off instantaneous transaction, they're the things to make a list of and sit down and have a chat about. So I think that, I don't know if you had any other top tips on income, Helen.
I still really like the mobile phone example, which is the one that has been coming up when FRS 102 was sort of first went through the refresh. It's the one you can get your head around, because when you buy a mobile phone under a contract, you're typically buying a phone which you can have instant access to, and you acquire the good at the point that you sort of make the exchange and you pay your purchase. But then over the life of it, you may also have the right to use your telephone services and Wi-Fi and to be supported. And so if you're paying a monthly contract, those mobile phone companies, you haven't bought your phone up front for £500 and then paying your kind of fees as you go along. You're paying for the phone over that life of that contract and for the other services. So they have to kind of work out the value of the different components of the bundle, and what would be the phone if you bought it as a standalone versus what's the value of the other stuff that you're acquiring as part of this contract. And I think when you then think about those kind of membership subscriptions, you know, where people might pay you £100 up front and they get certain benefits immediately, but they also get access to things over the year, that's where charities sometimes have equivalent bundles that they will have to unbundle for the purpose of working out whether SORP changes are going to make a sufficiently material difference to their accounting that they will need to change how they account for these things.
Yes. So yes, those are definitely our top tips. And yeah, any further questions, you can email them to us or to your usual Saffery contact. We're going to use the data we have gathered today to submit our responses to the consultation, which are due next week for the charity size threshold and the week after for the SORP consultation. So not long if there is something else that you want to kind of look into or answer yourself. And we will look out in just after the summer holidays for the further training that we are going to put on. Picking up on what you've asked us for today, we'll make sure that there's a whole suite that you can be invited to over the autumn and as you start doing this in practice. So thank you very much for your time today, and we look forward to seeing you all soon.